Great.
Okay,
How are you guys?
good. Jason, thank you in advance for helping us understand the mortgage process. We are just, at this point, it's just kind of a gray cloud over a transaction. So Jason, tell us a little bit about you, about your company, and the seminar is yours.
Awesome. Thank you so much. Thank you guys for having me. Definitely appreciate being here and being with you guys. I have prepared a quite extensive training for you guys. So, if some of this is a little too much, it's okay. You can feel free to follow up with me. I can go through everything with you in detail, but I'm going to try to hit all of the main things while keeping it high level. So first, we'll take a look at, pre-approval. So basically, what I'm going to do is I'll just show you guys, we have a CRM that allows us, for each point of contact, it allows us to create a pre-approval letter from the contact. So for example, let's say we were doing one in New Jersey and I was writing a pre-approval for myself because I'm going to go and buy a nice big brand new house with a brand new kitchen so my wife is not bugging me all the time. So purchase price, let's say 500,000. And let's say we're going to do 20% down or 100,000. So down payment 100,000, and then loan amount 400,000. And then the loan type, let's say it's going to be conventional, amortization, fixed rate. So if this was not, let's say there was no seller concession, no contingency, I would not include a note on the pre-approval letter. I would just create it as is. And then what you would receive is our pre-approval letter, which basically just lists the purchase price, the down payment, loan amount, the loan type, and it indicates that it's a fixed rate. So this is your standard pre-approval letter. The main thing that listing agents are looking for is they would just want to see that the date on the pre-approval letter matches the date of the offer. Because when it doesn't, right, that indicates that, maybe this pre-approval was for another property. Or maybe if the dates are really different, it could indicate that the pre-approval is just really outdated, in which case it would cause the listing agent to say, hey, when's the last time that this lender actually reviewed their documents? Who knows what could have changed between now and then? Is this just a blanket pre-approval letter? Blanket pre-approval letter, it wouldn't consider the taxes or perhaps HOA fee or perhaps flood insurance required for that specific property. So those are all, that's why it's really important to know that, or for the listing agent to see that the date on the pre-approval letter matches the date of the offer or the sales contract. Now, let's say, for example, they wanted to include a seller concession. I would just include a note here saying seller concession of 10,000. And then, we create a new letter and it would basically be the same thing, except it would include a note at the bottom. So now let's say, for example, there was a sales contingency. We can write sales contingency here. And then we would just create that. And then you would have the note stating that there's a sales contingency. So the buyer or the listing agent, when you submit an offer, they're going to want to know that whatever is on this pre-approval letter is consistent with how you wrote the sales contract and how you submitted that. Is that clear for everyone? Any questions or comments on that?
Yes, Jason, I'd like you to go back to that because a couple things I want you to point out.
Sure.
Pull it back up, please. Okay, congratulations. Could everybody please read that the pre-approval is based on?
Mhm.
Please read it. So you pull
And
up
I'm
the
also
credit,
gonna,
you pull up the credit history. Now, does the pre-approval go to underwriting before you issue the pre-approval?
no, it doesn't.
Okay, okay. And
And I'm
Could-
actually going to go through, so I also have a PowerPoint prepared.
Okay.
And I'm going to go through the process that, you know, that we go through when we issue a pre-approval.
Perfect.
And I'm actually going to go through, you know, how we review credit, income, assets, so on and so forth. But, you know,
Perfect.
we could note, right, that, you know, this pre-approval subject to an acceptable appraisal, title report, satisfaction of any underwriting requirements. It's based on interest rates, loan terms, and underwriting requirements that are currently available and is subject to change. And I can get into that as well. And then pre-approval is neither an interest rate lock-in nor a commitment for a loan and will expire within 120 days from your credit report.
Thank you.
So, you know what, instead, maybe I'll start here. So what we look at when we're evaluating whether or not someone can be pre-approved is, number one, we look at their credit. So we'll pull a credit report. When we pull a credit report, we're going to get information from each of the national credit bureaus, so TransUnion, Equifax, Experian. And in terms of credit score, there will be a high, a middle, and a low. What we do is we use the low. If there's more than one borrower, then we look at the high, middle, and low for each borrower, and we use the lower of their two middle scores. So why is that important? Because sometimes you have someone who says, oh, you know, I make a lot of money. I have a lot of money in the bank. I can put 20% down, but my credit's shot. So I'm going to add my daughter who just started working, and I'm going to use her credit score. Unfortunately, it's not possible. We look at the lower of the two scores. In credit, what we're also evaluating is, you know, have they had any bankruptcies? Do they have any derogatory items on their credit report, such as collections or charge-offs? Depending on the loan program, if they have any past due amounts that are related to collections or charge-offs, in some cases, depending on the amount, might need to resolve those past due amounts before they can qualify.
Jason, what's a charge off?
So a charge-off is when, let's say you have a credit card and you have an outstanding balance and you refuse to pay it. Now, let's say you owe $1,100 on the card. Now but you don't want to pay it. So the creditor is contacting you and saying, hey, you need to pay this. It goes from 30 days past due to 60 to 120. Now they deem it uncollectible. So in some cases, what they might do is send that debt to a collection company, in which case it would appear as a collection on your credit report. In other cases, they might say, you know what, we're never going to collect this debt. We're not going to send it to collections. What we're going to do is we're just going to write it off as bad debt. And that would be considered a charge-off. So there, you know, depending on how the creditor treats that debt, it would be classified on your credit report as either a collection or a charge-off. Does that make sense to you guys?
Mm-hmm.
Okay. Any questions so far?
Thanks, Jason.
I had one question, which this may be an absolutely stupid question. I don't know. Let's say something happens in the pre-approval letter you get to them is dated February 9th, and you can't get it to them until the 10th or the 11th. That date is still okay? Or does a new letter have to be processed on the 11th to be sent out with the paperwork?
You know, it really depends on the listing agent. I mean,
Okay.
For example, like you can ask for an updated, if it were me, I would ask for an updated pre-approval letter.
Okay.
The reason why is because it's just cleaner. You're going to face less questions. In some cases, like I've had a lot of people where when the dates don't match up, I've had a lot of listing agents call me and say, hey, is this current? Because the dates don't match. The date on your letter doesn't match the contract.
Got it.
So it really depends, but it might just be easier. You saw how quickly I just created that pre-approval letter.
Mhm.
So for example, like if I'm working with one of your clients and you need an update, what I just did from the laptop and I showed you, I can do that directly from my cell phone.
Okay.
So, it's really, really easy to get that over to you. So it wouldn't be a problem. I think it'd just be easier on you and for everyone's peace of mind to make sure that those dates match.
Okay, perfect. Thank you.
Hey, Jason, is that
You're
always
welcome.
standard,
Yeah.
120 days?
So 120 days is because your credit is good for 120 days from the date that we pull the report. So that's why essentially as long as your credit is good, the pre-approval is technically good. Now, if something happens to income or assets within that 120 days, well, then that could also impact your pre-approval. But generally, it's good for 120 days.
Jason,
Patty,
how
you're
much
on mute.
time before a client calls you and the credit is run, income, assets, all of that, before you can put together a pre-approval letter?
So typically the way that I approach a pre-approval is I will have an initial call with the client, and to pull credit, it takes about 2 minutes. You just have to ask for name, date of birth, social security number, current address. Then I can pull credit. And typically what I do on that initial call is I review the credit with the client. I will go through credit scores. I will go through any derogatory items. I'll make sure that they're aware of everything that's on their credit report, just because a lot of times, when we pull a credit report, it's much different than when whatever you see via the consumer reporting sites such as Credit Karma. So the score that you see as a consumer is going to be, and the details that you see as a consumer is going to be much different than what I see as a lender. So you're not going to see most of the derogatory items that are on your credit report. For example, I just had a client that I spoke with today, and I said, you have a collection from Uverse. And they said, what the heck is Uverse? And I'm like, it's AT&T. It's something with AT&T. It looks like a cable service. And the guy's like, I don't see that on my credit report. I said, you probably wouldn't. But what happened was, he's like, this doesn't make sense because I have Verizon. And I said, well, you should contact, AT&T and find out if this is, a valid collection. And what happened was they realized that it was actually someone in Texas opened up an account with that person's identity. And it happened to be a case of fraud where that collection actually didn't belong to them. So these are the things that we, it's not really, is it our job to do that as part of a pre-approval? No, but when you go down to that, when you do review it at that level, what happens is you're going to catch a lot of things that in some cases you may not have caught or someone else would not have caught. And, that will help us save you time when working with someone. So that's why we do it. So in addition to, credit scores, derogatory items, also bankruptcies, there's waiting periods in regards to, a bankruptcy, foreclosure, short sale, things like that, things of that nature. There are different waiting periods, which could, be based on the discharge date or the date of dismissal. And we go through that with each client. And then the other thing in regard to credit is a lot of people think that we look at the balances, like what's your total debt. We don't really care about that. The only thing that factors in is where your credit score will be impacted by what's called your utilization. So your utilization is refers to your credit limits in regard to your credit balances. So you might have a card with a $5,000 limit. If the balance is $1,000 on that card, then that means your utilization is 20%. Typically, in order to have, optimize your credit score, you want to keep your utilization at 30% or below. Now, if when we're looking at a borrower's credit score, that might help us. Let's say, for example, if their utilization is really high and their credit score is kind of low, we can look at that and say, all right, what can we do for this person? How can we advise them in order to help them lower their utilization and raise their credit score so that they can get a better interest rate? So we will do that for a borrower. Again, that's us taking the extra step to try to make sure that your buyers are in the best position possible when making a home purchase. And that really helps you secure the deal. By us doing that extra work and going that extra mile, we try to, before they buy, we try to put them in the best position possible and make them aware of, what they need to do going forward and, how they need to maintain their credit in order to put themselves in an optimal buying position, which will only help you solidify the deal. Now, what we're most interested in terms of the pre-approval is we're looking at what are their minimum monthly liabilities. Because their minimum monthly liabilities, that's what's going to factor into the debt to income ratio. So their minimum monthly liabilities, for example, would be if they have a car payment, it's $400 a month. They have 3 credit cards, and the minimum monthly payment on those cards are $50 each. 50 times 3 is $150. Add that to the 400. That means their minimum monthly liabilities, $550 per month. And that is what gets compared to their gross monthly income in order to calculate their debt to income ratio. So essentially, the important things to remember there are when it comes to debt to income ratio, the balances, we don't care. They can have $1 million in credit card balances. If their minimum monthly payments are only $500 a month, then that's all we care about because that's what we need for the debt to income ratio. Now, some people have liabilities on their credit report that are paid by a business. Those can be excluded as long as they can provide 12 months of business bank statements showing the payment leaving their account. So that's one way to lower debt to income ratio. Let's say, for example, they have student loan payments. I have someone that I work with that can help them get into a student loan income-based payment plan, which if we can lower and sometimes eliminate their student loan debt and bring their minimum monthly liability with respect to that student loan debt to 0. That's a huge help. The other thing is that when it comes to debts, mortgages, let's say they co-signed for another borrower. If they co-signed for another borrower and the mortgage, the other person's mortgage is showing up as a liability on their credit report, if they can show that that other person has made 12 consecutive payments on that mortgage, then we can exclude that debt from their debt to income ratio. So that's a very important thing when speaking to certain people. And the reason why I tell you guys all of these little details is that a lot of times when you speak to people about buying a home, they're going to give you what? What will they give you? What do you have to overcome when you're trying to get someone to purchase a home? Anyone know? Have any of you guys done a prospecting class yet? And what do they teach you in prospecting classes? How to overcome
Did you
Objection. I think, yes, how to overcome objections, right? So these are typically things that you might hear from borrowers or buyers. Well, I can't buy a home yet because I just co-signed for my son, or I just co-signed for my uncle or my sister. Okay, you just co-signed for your sister. How long have they been making the payments for? 12 months or 2 years. Okay, great. Or, we can exclude that debt from your liabilities. You should talk to my mortgage advisor. He can help you. See, these are things that people don't know. And if you have that knowledge, when you're talking to them, you can use this knowledge to overcome those objections. I just had a bankruptcy, or I had a bankruptcy 7 years ago. Well, if you know what the waiting periods are, you know that person can probably now qualify for a loan because you know the waiting periods. So you're not, as new agents, you're not going to know all this stuff right off the bat, but it is very important to know or to learn as much as you can, not just about real estate, but about financing, so that you can overcome objections when you're talking to people, because you might be able to help someone purchase a home and accomplish their goal just by knowing that information. That is what's going to separate you from the agent, from another agent. And that's really what's, what separates, the good from the great, or the great from the good. That, in regard to credit, those are some key points just to kind of be aware of and keep in your back pocket. This way you can overcome objections. Now, so we'll go on to the next thing. Credit will obviously impact the interest rate. That's one of the credit and loan to value, or their down payment. Those are two of the biggest things that will impact interest rates. The other things will be what type of home. Is it a primary residence, second home, investment? That will have an impact on the interest rate. The occupancy type. Is it a 1-family? Is it a 2-family, 3-family, 4-family? Is it a condo? Is it a townhouse? Is it a single-family detached residence? All of these things will impact the interest rate. And then in regard to income can be very complicated to calculate. If it's someone who's a W-2 employee, that means they receive a paycheck, and that means that they get taxes taken out of their paycheck. So if they get taxes taken out of their paycheck and they are a salaried employee, it makes it very easy to calculate their income, because it's very predictable, right? If you get paid $120,000 a year, that means your gross monthly income is $10,000 a month. It's a salary. It doesn't vary at all. That's very easy to calculate. Now, if they receive bonus or commission, if they're hourly, if they receive overtime, these are all variable sources of income. So in those cases, what we typically need to do is we need to reach out to their employer, and we need to ask their employer to break out their hourly wages versus their overtime versus their bonus versus their commission. And what we do is we ask for a breakout for the last or the most recent 2 tax years ended. So in this case, 2019, 2020. And then we also ask for a breakout for the year to date. And what we're doing is we're calculating the income based upon those numbers. And typically what we do is we take the most conservative estimate. So essentially what we want to see is that whatever form of income we're using, whether it's the base salary or commission or bonus, that it's going up year over year. And then if it's going up, we could typically take a 2-year average, or a year-to-date plus 1-year average. Not to get too much into the weeds here, but just to kind of give you an idea of what we need to ask for, what we need to request, and how complicated it is, whether, depending on how they're earning their income. If it's someone who's self-employed, We typically go off of the most recent 2 tax returns. So if someone has recently become self-employed, let's say they were W-2 employee in 2019 and 2020, and they just started a new business in January. Well, they're not going to have enough, they're not going to have, I'm not going to have anything to use to calculate their income, right? Because when it comes to, I can't go off of their W-2 income because they're no longer a W-2 employee. And I can't go off their business income because they haven't filed a tax return for that business yet. So I have nothing to go off of. So basically, when it comes to self-employed, what you typically need a 2-year history of self-employment. And self-employment could include someone who is a sole proprietor, meaning they work for themselves as an independent contractor. They get a 1099 at the end of the year from each person or each company that they do work for as a contractor. Or they can be a business owner. If they're a business owner, they might they could be have an LLC. They could have a limited liability partnership, a corporation. The calculation, the income calculation would be different for each type or each category that I just mentioned, but all very similar. Now, so income, I think the main, that's some detail, some high level detail for you. Believe it or not, that is high level detail. But the main takeaway when it comes to income is that if it's a W-2 employee, we go off of the gross monthly income. So that's before taxes. So that means that, we'll go off of what's reported on their W-2, not the net amount after taxes in their paycheck. And then if it's a self-employed borrower, we're looking at their net income. So there's certain expenses that we can add back. So that's where the calculation gets a little complicated, but we're going off of net income and we're able to add back certain things like depreciation, so on and so forth. Rental income, if they own investment properties, then we can use rental income, but there are some restrictions due to COVID. In general, we can use rental income typically to offset whatever mortgages they have on the property. And what we would need to do is typically if they have filed a tax return, like let's say it's someone who just purchased a rental property this year and they haven't filed a tax return yet, that means that they haven't reported that rental income on Schedule E of their tax return, and they haven't shown what the expenses might be. So in that case, we would go off the leases and we would apply a occupancy factor of 25%, which means that we can use 75% of the rental income from the leases. If they have filed a tax return, then basically there's a rental income calculation that we use where we take the net rental gain or loss off of their Schedule E, and we can add back certain expenses like mortgage interest, property taxes, so on and so forth. But essentially, the reason that we're looking at income is because, we want to see typically at least a 2-year history of employment minimum. If it's someone new who just graduated from college and they just started their job, we can use their college education, their degree, as educational professional or employment history. In which case we would just ask them for their transcripts, and that would allow us to get them. That would satisfy the 2-year requirement. And then assets. So assets, we're really just looking for proof of funds, right? And typically what we're requesting are just 2 months of the most recent bank account, or 2 months of any investment or retirement accounts, or the most recent quarter, if it's a quarterly statement. And what we're looking for by requesting the 2 months is that, if it's a bank statement, we want to make sure that we don't see any large deposits. If we do, then we just have to source those deposits. Now, as long as we can source those deposits, they should be fine. We should be able to use them. But let's say, for example, if someone has $60,000 going into their bank account, and we go to source that deposit, and they say, yeah, it was just a cash deposit. I had money sitting in my safe or under my mattress. Not acceptable. Basically, they would have to wait until we no longer see that deposit into their bank account, and then they would have to send us like updated statements so that we wouldn't have to source it. Sure, question, Cheryl?
Yeah, I'm just a little confused. I may have missed something. So when you said you were looking at like someone's 2-year history of employment, and if it's a college student that just graduated and just started a job, you would look at their their college degree. How does that compare to someone that's worked? Like just because they're making X number of dollars, does that get compared against student loans and things?
So basically the way that it works is that, let's say that you just graduated from a 4-year university, and you have your bachelor's degree in accounting, and you go to work, you just got your first job, and you're working for, a public accounting firm, PricewaterhouseCoopers. And this is your first job. You've been there for a month. So you have a month worth of pay stubs, but you only have 1 month worth of employment history. We can use your 4-year degree to satisfy the requirement for 2 years of employment history. Your educational background, from an accredited university, will count as employment history. So you can use that.
But then obviously if there were student loans or they had high credit cards, I mean, that would all take into account, correct?
Well, student loans are a separate issue, right? So one issue is, do they have the necessary employment history, which will allow me to use their income? The other question is, do they have, in regard to their student loan debt, how does their student loan debt, how does the minimum monthly payments on their student loan debt, how does that compare to their gross monthly income?
Got it.
So the fact that they have student loans and the fact that they have student loan debt will not preclude them from qualifying or prevent them from qualifying. It's just something that needs to be factored into the debt to income ratio. And, their debt to income ratio is going to determine whether or not they can qualify. So, for example, if, number one, you're trying to validate the credit and determine what the total minimum monthly payments are, so their minimum monthly liabilities. Number two is you're trying to figure out how much income can I use to qualify them, and in determining that, one of the factors is, do they have a 2-year employment history? So if they don't, but they did graduate from a 4-year university, then I can use those transcripts and that diploma to satisfy the requirement for 2 years of employment. Because basically, right, it's like if they went to a 4-year university for accounting and now they have a job in accounting, they earned a degree that will satisfy, that basically qualifies as experience.
Got it.
They'll allow them to use that as experience so that they can use their income without having to wait 2 years of earning that income.
Okay.
Does it make
I
sense to you
understand
guys?
Yeah,
So
that makes sense.
that's income. Oh yeah, sorry. Did someone else ask a question?
Oh, sorry, I said it. That makes sense. Yeah, sorry about that.
Okay. No, that's okay. Thanks, Nancy. So, and then, yeah, assets. So, assets, it's all about, proof of funds. So, if it's from checking or savings, obviously very easy. Those are both liquid cash accounts. Investment, like a brokerage account, stocks, bonds, those are all very liquid, can be converted to cash pretty easily. There may be some tax consequences in relation to the liquidation. So, if it's something where, it's close to the end of a tax year, and they might not complete the purchase before they file their next tax. Like, let's say, for example, it's February. Let's say taxes are due by April 15th. Someone has $100,000 in a brokerage account, and they're saying, I'm going to use this 100K as my down payment. Okay, that's fine, but you're going to have to liquidate that. You're going to have to pull it out of your brokerage account. And if you do that, let's say you have to pay taxes on it. Obviously, if you're doing it in early 2021, you shouldn't have to pay taxes on that until you file your 2021 return. So that should be fine, right? You could probably liquidate it all. You get all the cash. You just, we would just tell the borrower, hey, listen, you're going to have to pay taxes on this at the end of the year. So just make sure you have some money set aside. But, those are accounts that we can use. Now, if it's like a retirement account and they're going to take a loan against their 401k, then as long as the 401k is with their current employer, it won't impact their debt to income ratio. Because let's say you have a 401k and you take a loan against it. When you pay back your loan, you're actually paying it back from your paycheck. And if we're using your gross income, then that loan that you're paying back is not going to affect your debt to income ratio. It won't impact your liabilities because it's being taken from your gross monthly income. So because we go off of gross monthly income, if you take a loan against your 401k with your current employer, it will not impact your debt to income ratio. So it's a great way for people to, if someone says, if you're on a call with someone and they say, I don't have any, I want to buy a home. I have a great job. I'm a bad saver. I haven't been able to save any money. Okay. Well, you mentioned you have a good job. Do you have a 401k? Yes, I do. Okay. Is it with your current employer? Yes, it is. Okay. Well, I don't know if you know this, but you can actually take a loan against your 401k. In most cases, it can be the greater, or it can be either 50% of the loan balance or $50,000, whichever is less. So, and if you do take the loan against your 401k, obviously you're going to be paying that back. You're going to have to pay it back, but really you're paying yourself back because you just borrowed the money from yourself, right? On top of it, it's not going to impact your debt to income ratio. So it won't impact your ability to qualify. So those are all really helpful tips and great ways to overcome objections when speaking to potential buyers. But as far as proof of funds is concerned, sourcing the funds, cash deposits, not acceptable. Gifts from, relatives, are acceptable. So that we just need a gift letter. We'll also need the account statement for the person giving the gift. That's called a donor account statement. And then we'll need an account statement for the person receiving the gift. This way, we're just being able to see, you know, the funds leaving the person's account, entering the borrower's or the buyer's account, and then also a gift letter stating that this is a gift, it's not a loan.
Who does the, I'm sorry,
And
who
that
does,
would-
the gift, who does the gift letter come from?
So let's say you're going to buy a house, Leslie, and your mom is going to give you $50,000 for the down payment. Basically, she can write you a check for $50,000. You can deposit it into your account, and then she can, when, you know, during processing, when we're processing the loan, we would give you a gift letter,
Oh, you would. Okay.
and we would actually provide you with the gift letter, and then your mom would just sign it, fill in the amount, and that would be it.
Okay.
And then we'd also ask for her account statement showing the funds leaving her account. We'd ask for, well, we would already have your account statement showing the funds entering your account. And then, you know, we would have everything we need.
Thank you.
Okay. So, yeah, credit, income, assets. Those are the three things. Those are basically the three things that we're looking at when we do a pre-approval. Now, there are some other things. Am I still sharing my screen? Yes, I am. So, okay. So this pre-approval is subject to an acceptable appraisal. So one thing to keep in mind in regard to the appraised value, when we're talking about loan to value, the value is going to come from the appraisal. So let's say, for example, someone is, you know, this is relevant in this market because homes are going for over ask, right? So let's say someone makes an offer for $500,000 on the home, and they do the appraisal, and it only comes back at $495. That means the home underappraised by $5,000. Now, what happens is there's a choice. Either the seller can reduce the purchase price, or the buyer has to come up with the additional $5,000 in cash. So if they were putting $100,000 down before, now they have to put $105,000 out of pocket. So typically there's an appraisal contingency in every sales contract, and that would give the buyer an out. So if the seller was not willing to reduce the purchase price, and the buyer was not willing to come up with an additional $5,000, the seller can say, okay, I'm not going to move forward with the deal. So that's something that you should be aware of. The other thing is, let's say the seller or the buyer is asking for a seller concession. So let's say the buyer wants $490,000. If the seller wants $490,000, if the buyer wants to ask the seller for $10,000 to cover closing costs, that's called a seller concession. What they would do is, and how you would structure the offer is, you would offer the seller $500,000 with a $10,000 seller concession. What that means is that the seller will get $490,000 at closing, and then the buyer will get $10,000, and it will get wrapped into their loan to cover the closing costs. So that means that instead of the buyer having to come up with $10,000 at closing, they're getting the opportunity to wrap it back into their loan. Now, why is this relevant when we're talking about an appraisal? So if you make an offer of $500,000 with a $10,000 seller concession, what's going to happen is the home has to appraise for $500,000. If it only appraises for $490,000, then the seller cannot give the buyer the $10,000 seller concession. The loan amount cannot be greater than the appraised value. So title report, obviously that's just making sure that when the ownership passes from seller to buyer, that it does so with a clean chain of title, meaning no one else can come and say, hey, no, that home is mine. And then obviously a pre-approval is really, it's when a loan officer evaluates credit, income, and assets and makes a decision in regard to that buyer's ability to purchase the home. So that's what's called a pre-approval. It's when the loan officer is doing the evaluation. A loan commitment is when the underwriter does the evaluation. And a loan commitment cannot be issued without an appraisal. So in some cases, you know, normal environment, a lot of times what will happen is our underwriters will will review a file prior to the appraisal being done. In that case, what we would do is they would issue the initial loan approval with conditions. Again, they cannot issue a commitment without the appraisal. So if they issued a loan commitment with conditions, and then we receive the appraisal, it goes back to underwriting, and then underwriting will review all of the qualifications once more in addition to the appraisal, and then they will issue the loan commitment. The loan commitment will also have conditions. Typically those conditions are, you know, they need to see homeowners insurance paid for a year. They need, you know, the title work back from the title company. They'll need, you know, to see that the earnest money deposit has been deposited into either the seller or the buyer's attorney's escrow account. Typically it's the seller's attorney escrow account. And then once all that has been done, and let's say, you know, sometimes we might need, depending on the amount of time that passes, we might need updated pay stubs, something like that. We might need an updated bank statement. Once all that is resolved, all those conditions are resolved, it goes back into underwriting. Underwriting issues what's called the final approval. And then once they issue the final approval, it goes to our closing department. Our closing department does a quality control review, and they issue what's called the clear to close. Once a loan's clear to close, the initial CD is issued, and there's typically a 3-day period between when that initial CD is signed by the borrower and when they can actually schedule the closing date. The attorney, the buyer's attorney, and the title company will coordinate to schedule closing once the clear to close has been issued. So one common misconception is that, you know, the lender, so us as a lender, that we will schedule the closing date once the clear to close has been issued. But, you know, one thing you'll want to remember is that it's actually going to be the buyer, the buyer's attorney, and the title company or the settlement agent from the title company. The three of them will coordinate to schedule a closing date, but they can only do that once the clear to close has been issued from the lender. Okay. So let's see. It's based on change. As far as interest rate locks, So when is someone locking in, or when are we locking in an interest rate? The answer is that really depends. So in some cases, someone might have an offer accepted, and what would happen is, let's say they have an offer accepted, they go into attorney review, the attorney, after the attorney review period, they're now under contract. Once they're under contract and they have e-signed their loan disclosures, we can then lock their interest rate. But depending on the environment, we may or may not lock their interest rate. If interest rates are high and we expect them to maybe, cool off a little bit, then we might advise them to wait and to hold off on locking in a rate. So it really is up to the buyer. We advise them in regard to, what we think, and we make our recommendation. It's really up to the buyer, but typically in any transaction, we will not lock a rate until they are under contract and their loan disclosures have been e-signed. And then we advise from there. So, I mean, that's sort of, not just a breakdown of the pre-approval letter, but it's also a pretty good summary of the pre-approval process. Just to kind of recap: credit, income, assets. Those are the things that we're looking for. What I would recommend to you is that, what we do is, you might hear some differences between a pre-qualification and a pre-approval. Pre-qualification means that they have not reviewed the borrower's documentation. They haven't pulled credit. They haven't validated their income and assets by requesting their W-2s or tax returns. Pre-approval means that we have. And a pre-qualification is great when you're just discussing a borrower's budget to try to give them some home search parameters, but a pre-approval is required to make the offer. And I would say I would highly recommend having your buyers pre-approved prior to spending a lot of time showing them homes. I know this is a different environment, so probably doing a lot less showings, I would say, and maybe more Zoom meetings and whatnot. But I would definitely say, even before you spend a lot of time with these borrowers and trying to find them a home, I would say, really, encourage them to get pre-approved so that you're not wasting your time unnecessarily. All that being said,